Guy Adami, were you watching the stock market more, or were you watching the bond market and rates more?
Bond market. I mean, without question. I heard Pete talk last week about this. It's all predicated on the bond market, and people get tired of listening to me say this, but I'll say it hopefully for the final time. I mean, the fact that the bond market is as volatile as it is here in the United States, largest economy on the planet, it's comical. I mean, one of the mandates of these, the Fed, I was going to say something else, but I'll say the Federal Reserve is stable prices. Well, the bond market's been anything but stable for the last 18 months, and specifically for the last couple of weeks. It is almost comical. It's a joke. I'll say this. The only panic I've seen over the last couple of months has been to the upside, these huge days on the upside. I thought today, at least late, that last leg lower felt like a little panic to me. And in my world, it's actually sort of an encouraging sign.
Yeah, Tim, I don't want to get too wonky to start the show with the stock market pain, but there's a lot of stuff going on in the bond market. In fact, some Treasury bonds trading below repo rates overnight. There seems to be some weird stuff that's happening in the credit markets, and that's got to be hitting stocks.
Well, you can't have these types of move in the bond markets, especially where you have extremely levered players. And this move in rates, and again, we're talking about 150 basis points on the 2-year note, but we're back 14 and a half years to, a 2007 handle on the last time you saw short rates this low. I don't think people expected this type of move. And you talk about some of the dynamics, especially what's going on in the mortgage market, especially when the Fed was buying MBS. And I think Diana Olick's going to be on our show, and we're going to talk about mortgage markets, because the impact here is part of where I think the Fed needs to exist. I just, the comical part about this, as Guy used that term, is really about where monetary policy was. And I know it's easy to say that in hindsight. The reality on a day like today, after Friday's CPI and PPI around the corner, is that we all have this view inflation is not only not transitory, but that, in fact, this is the kind of the thing that Paul Volcker had to squash in the 80s, and that they may have to move a lot more aggressively. That's what the market's doing today. That's what the bond market did today.
Right. So we talked about bonds. We talked about stocks. You got to talk about currencies, too. Look at the dollar making new 20-year highs. And we got to go back to just a couple weeks ago when Microsoft had that warning about their fiscal Q4. They're warning about the strength of the dollar and how that's going to hurt their profit margins. And at the time, and we've been saying it since then, while it wasn't a huge miss, it wasn't a huge guide down, this is something that a lot of U.S. multinationals are going to be faced with, which also just basically helps make the case why we think the fact that earnings estimates for the S&P 500, which as a couple weeks ago were still expected to be up 10%, are likely to be up maybe low to mid single digits. And also
just on currency,
on currency, on energy, we're going to get to energy, on all of these sorts of. And then if we're talking about demand destruction, right, then lower sales. And just to put a little framework on this, Adami over there, who's sitting there in New Jersey, he's been calling for 3750 in the S&P 500. And I want to be really clear about this, because he's not going to do it himself. He's been saying that the S&P in this environment should probably trade about 17 times. You put 5% year-over-year EPS.
Where
growth.
are we now?
Well, it's a little above that. Okay, so my point is, he was thinking 5% earnings growth year-over-year for this year. That gets you about $220. You multiply that down 17, you can do that math. That gets you to 3750. I mean, that was his number. And, that's why I think, you got to put some frameworks around some of the stuff you're thinking about. Are we likely to overshoot to the downside? Maybe.
Yeah, and, Pete Najarian, again, going into the credit markets, because this guy Adami, Nostradamus, will say they are sort of the bigger market. And there's all this wonky stuff that's happening with sort of repo rates and overnight. Let me ask you a direct question, which maybe, doesn't go into the weeds of the bond market. Do you believe there is currently, or the risk of, a real liquidity issue in parts of the bond market? And that's bleeding into equities as well?
It's a really great question, Brian, and I think that probably is the case. I mean, and I would say this is what would defend that, my saying that, is the fact that look at the velocity of this move. In the last 2 weeks, we have watched what's gone on with the 2-year and the 10-year. The 2-year was 2.58, and it's got out all the way up to 3.3. And then the same thing with the 10-year. It was 2.78. Now it's over 3.3. So when you see that kind of move, that tells you a lot. And it tells you a lot about what's going on in the bond market and that scramble that we're seeing. On top of that, how about the fact that just a week ago, the volatility index was 24. Today it's 34. Matter of fact, the VXN, the volatility for the NASDAQ, that was down there at 34. Now it's over 40. It's 41. So it gives you an idea of how fast these things are happening. And I always use that word velocity. It's the velocity of these moves, Brian, that I think has people so confused, and that's why we're seeing palms out as frequently as we are. In other words, people are just saying, you know what, I don't get it, I'm selling. And that's exactly what we've seen for the last 3 or 4 trading sessions. That's why I think the size of these trades has become so big, is velocity is causing this whole thing.